We're gonna give it a few minutes. Welcome everyone. So, but we're gonna talk about impact and ESG. You see, it's not impact. It's different. You're saying it's going away.
Yeah, I think that ESG. I'm on the impact committee at ADISA. So ADISA is a nonprofit organization that talks about alternative investments. And we're as a committee, and we're not the only ones talking about it. But does ESG kind of go away? And because a lot of it's just good business sense, common business sense anyway. Like take the environmental, right? So in the world that we're in, just apartments, right? So low flow shower heads, aerators on the faucet, programmable thermostats for electricity, right? Native landscaping. Like, does that really need? I mean, you should be doing that anyway because it makes sense, right? Both from an economic point and an environmental. But an impact is more of a catch-all. Hey, are you making an impact? Are you making the world better? Cool, let's hear about it.
Right.
You know.
And just like for people joining now, just like we're just having a pre-webinar conversation. We're going to give a few more minutes to give a chance for people to join. I know this is like very weird, the quarter before the hour. Usually webinars start at the hour. So also going to give some time to get closer to that. We're not going to wait until the hour, but anyway, just give me a few more minutes. Yeah. So I also wanted to, like, what we're talking about now, Bo, is like, I think it'll be interesting when we dive into the whole topic.
Sure.
We'll dive deeper into that because I completely agree. We also had a really interesting conversation, one of our previous webinars, about ESG and the fact that, there's ESG and then there's like, it's always anti-oil and fossil fuels and stuff like that. But we still consume all that, and every product we consume needs oil. And so ESG has created a situation where we're going into a deficit where we don't have enough oil to generate. So anyway, it's like this really weird combination of things. All right, a minute more, and then we'll kick this off. Let me just close my stuff so I don't have any noise coming from.
And I know we're just kind of chatting here. I know you're in Israel. I'm in Colorado. Danielle, where are you?
I'm also in Israel.
Okay, cool.
Yes.
Good stuff.
Yeah.
At least the weather here is a little bit better, I think, than in Colorado.
Yeah. What's
Hey,
the time?
I want some snow. What do you think? How can it be better?
I've already had my share of snow. I was skiing recently in France, so
Okay.
I had my share of snow for this year. But Colorado is lovely. I would love to visit there again.
Yeah. All right.
Yeah, let me know when you come out. Let me know. Either one of you guys come out. Let me know.
Yep. We did that. I did that, and I promised that I did. Right? We did
Yeah.
that. I'll do it again for sure. All right. Let's kick it off. So welcome everyone. I'm super excited for this webinar. Welcome to Vyzer Visionaries. I'm Litan Yahav, your host. I'm the co-founder and CEO at Vyzer, and we help people with more sophisticated, complex investments track everything and automate their wealth. But on top of that, we want to help also the community of both our clients and everyone else who's investing sort of improve our knowledge and think outside the box when we talk about investing. And that's why we have these webinars. And I'm super excited to bring on to this one a really good friend, Bo from DLP. He's an awesome dude. He has a really interesting backstory, and they're doing some really cool things at DLP. Just to say, it's important for me to emphasize, because I've been asked, we have no affiliation with DLP. This is strictly knowledge. And because I love what Bo does, that's why he's on here talking about impact investing. And without further ado, Bo, I'll turn it over to you, give a short intro, and let's dive into it.
Well, thank you. It's nice to meet your community. It's an honor and privilege to be here. So thank you both for having me. It doesn't go unnoticed that you made time for me to educate your community, and I'll do the best I can. How about that? Okay. Is it okay if I grab the screen?
Of course. Go for it.
All right. Okay. Can you all see my screen? Can you see it?
Yeah, we can see it.
Okay. All right, everyone, let's dig in. So the two most important moments of your life are the moment you're born and then the moment you know why. And a lot of people don't know their why yet, or they're still on their journey. You can have more than one why. But one of my whys is and part of my legacy is to have an impact. I'd like to try to leave this world a little bit better than I found it, and I'm just trying to do the best I can. Okay, so that's very important when you kind of combine your why, and it's very important to know that. So the title today, Impact Investing, making a positive impact on the world while making a financial return. So just so everybody knows, right, that's what impact investing is hey, I can solve a problem in the world and I can make a financial return at the same time. Okay, that's pretty darn cool. It's like having your cake and eat it too. And by the way, folks that want to just focus on purely making alpha, that's good too, and that's awesome. What we always say to people is we're here to enjoy your journey and not judge it. But today we're going to focus on impact investing.
Right, and just just housekeeping. We have Danielle here, and the Q&A is open and the chat's open. So if you guys have any questions, feel free to write it, put it in the chat or the Q&A. If it's urgent during the presentation, we'll answer it on the go, and if it's not, we'll wait till the end and then answer all the questions. And second, give some background about you, Bo. I mean, I know you, but they don't.
Sure. So I am married to an awesome woman whose name is Meredith. She's a hospice chaplain, and she also runs a crisis management consulting firm. We have 2 boys. They're 12 and 8. We live in Colorado. I work out of St. Augustine, Florida. I'm on the airplane a lot. So for those that are airplane road warriors like me, it's nice to see you. So, and I've published 3 books on, mountain climbing and leadership. I have climbed the 7 summits. So the 7 summits, for those that don't know, there's 7 continents on the planet, and I've climbed the tallest mountain on each continent, which is pretty cool. And I set up an educational scholarship for each climb, which is pretty cool. I work for DLP Capital. I'm a managing principal there, where I have a couple slides on DLP, which I'll just give you the quick nickel tour of DLP, and we'll chime into it. But I love ski mountaineering. I love writing books, love my family. And, I'm kind of a foodie too, but, but that doesn't mean I also like hot dogs and hamburgers and mac and cheese. So if that, hopefully that counts too.
Awesome.
Yeah. Thanks for asking. So I think just a quick nickel tour, everybody, on DLP, and then we're going to jump into impact investing. So DLP, where I work, as I mentioned before, is an impact company. DLP is a private real estate impact investment company focused on solving the nation's attainable housing crisis. That's a big one. It's a big crisis, and we're laser focused on it. So to address this crisis, DLP finances, develops, and operates thriving communities where residents can flourish and investors can participate in the returns. We're fully integrated, everybody. So we have, investment funds, as you can see here. We have investment fund management, memberships, real estate acquisitions, lending solutions, capital markets, development, construction, portfolio and asset management, property management, and resident enrichment programs. So we do as much as we can to be fully integrated. We think that we can solve this crisis faster and better that way by being fully integrated, and also take care of the investors and our team members. Okay. So, just some of the impact numbers. We're about 5 starting here on the northeast side, or the top right. We're at about 5.25 billion of total assets under management. I'll jump over to the far upper left. We have about 2,900 families that invest with us. We typically raise, somewhere between 300 or 400 million a year from our investor base and new investors. This right below the 2,900 is 800 plus. So that's DLP Capital team members and their families. We collected about 54 million in affordable rent, which is pretty cool. We track productivity per person. So I'm kind of in the middle of the slide on the right. This is very important for those of you that are running businesses or in businesses that are in the audience. So our PPP, we call it, or our productivity per person, is about 394,000. As a point of reference, we think Apple is about 2 million. So we're slowly trying to catch them. We invested about, on the bottom left here, about $2 billion of capital invested into building thriving communities in 2023. We have about 40,000 residents who live in our new rental homes built to be affordable for families. We've created over 10,000 jobs. Okay. All right. So that's a little bit about DLP. So what is impact investing? So a wise person once said that the furthest distance in the universe is the distance between your head and your heart. And when you hear about either a nonprofit or someone that's doing impact investing, normally your heart hears it first. And wow, that's a really great idea. You're helping people, you're making the world better. And you're reaching for your checkbook. How do I help? That's your heart. Well, then your head gets in the way and goes, well, wait a minute. How long have they been in business? Are they actually solving the problem? Do they have audited financials? Do they have a track record? Are they going to be efficient with my capital? How involved are they? Where are they geographically? What's their heat map? So what I like about impact investing is it merges the distance between your head and your heart. Okay. So let's keep going and let's unpack this further, everybody. So impact investments are investments made with the intention to, number one, generate positive, measurable social and environmental impact alongside a financial return. Be made in both emerging and developed markets. And number three, target a range of returns from below market to market rate, depending on the investor's strategic goals.
I think this is a super point. I think point number one, sorry to interrupt, Bo.
No worries.
Point number one is like the exact difference between a donation and an impact investment, right? Because, the first one is, yeah, I'm doing good in the world, but I don't expect anything in return. And this aligns those interests where I'm also doing good to the world, but I'm also going to generate returns, right? And I don't know if you're going to touch on this, but the third point, they can also be above market rate, right? So.
Absolutely. And it really comes down to the investor or the family or the endowment or the institution. And you can kind of build your impact portfolio really any way you want, which is kind of fun. So on that note, there's a impact assets, I believe, is a nonprofit. They have a bunch of, they probably have hundreds or thousands of investments out there. So if people do want to learn more, impact assets is a great resource for people, for sure. So there's a wide range of investors, right? So a lot of people, maybe if you're hearing this for the first time, or maybe you've read a couple of articles, but who's doing it? Is this new, or what's going on here? So there's a lot of individuals, institutions already making impact investments, which is absolutely wonderful. So these are fund managers, these are financial institutions, private foundations, banks, financial institutions, pension funds, insurance companies, family offices, individuals, NGOs, religious institutions, and corporations. So it's a pretty, we're about to discover, it's a pretty big space, and a lot of people are involved with it. I would say it is still, it's growing. We are not at the tail end of this story at all. We're in the beginning. So what are the elements of impact investing? And there's really,
I have a question.
Yeah, sure. Jump in.
So just at the previous slide, when you talk about I'd say the allocators who allocate capital into the impact investing space, some of these are required by law, right? Or is that only into ESG, right? Right? There are some like large institutional pension funds, even NGOs, that are required by law to allocate a substantial amount of their portfolio into ESG/impact. I know there's a whole debate about that. We talked about that before the call, but is that true, or is that just like a urban legend?
It's a good question. I've written it down to do more research on it, but I don't know if it's an official law, but a lot of these organizations that are on the screen here in front of you are mandated. That could be a self-mandate. Maybe the owners or the founding the founding members created it where they have to do it. So I don't know if it's a law per se for some. I want to look into it. It's a good question. But a lot of them have a self-mandate or are mandated to do all of their portfolio or a portion of their portfolio in impact investing.
And are there also tax benefits for this? Or is that also?
There could be. For example, like if you're investing in like an opportunity zone, right? There's some tax benefits there. Hey, let's go to an area that's been kind of neglected, and let's rebuild an area in a rougher part of town, right? So the opportunity zones, as many people know, there are some tax benefits. There's probably quite a few if we were to unpack that. But those are, yeah, I think that some people's investment decision may be, hey, I want to do impact investing and really look for these tax savings, which is totally fair. And some other people may be less interested in that, just be less interested in that piece, and that doesn't concern them as much. So right. There are some tax benefits for sure. It's a good question. Cool. Okay. So there are really 4 key elements to impact investing, and number 1 is intentionality. And let's just unpack this a second. So there's a family that I know where they've been incredibly successful, and grandma died of cancer, and then grandpa died of cancer. Well, guess what? Now mom has cancer, and they're marshaling most of their resources now to cure cancer. So what are they doing? Well, they're in some pharmaceutical companies, right? They're big pharma, mid-sized pharma, small pharma. They're in biotechs, they're in venture capital, healthcare venture capital. And most of their portfolio they're totally galvanized around how do we cure cancer? Well, let me tell you something, everybody. If you cure cancer, okay, that is one heck of an impact. Okay. I mean, think about the ripple effect that would have on the world. So on one end of the spectrum, you've got this family that's all in on one specific thing, which is totally cool. And to go back to what we talked about earlier, this is really a personal preference, either for a family or an institution that has kind of mandates in certain areas they want to focus on. So the flip side, everybody, is just take Warren Buffett. His zone of genius is, hey, I want to make as much return or alpha as possible. And he's not really good. He's openly admitted this. I'm not really good. He's not really good at impact investing, but he's going to give most of his wealth to the Gates Foundation. Okay. And the Gates Foundation does a ton of this. So there's really, just to be clear, we're here to enjoy your journey and not judge it. There's really 2 sides. There's a spectrum here, and there's a bunch of people in between. And there's really not, hard to find a wrong answer per se between the two ends of the curve that I just described. But intentionality is a big piece, and some organizations and families have that intentionality, and some are in the process of learning it, and it's all okay. Number 2, you have to invest with the return expectation. Okay, kind of by definition there. Number 3, there's a range of returns, as we talked about before. And there's a lot of different asset classes, right? There's cash equivalents, there's fixed income, venture capital, real estate, private equity. There's just some amazing leaders out there that are solving some of the biggest problems and crises in the world through impact investing. And then the 4th piece is you have to measure it, right? You have to be able to measure whatever your impact is. So those are some of the key elements, okay? So the market size, I normally hold this side, when I'm speaking in person, I hold this side back, and I ask the audience to guess. And some people, it's a $10 billion market, or it's a $100 billion market. It's almost a $1.1 trillion market, which is absolutely huge. And I would be remiss if I didn't mention GIN here. So the Global Impact Investing Network is a great resource for people to learn more, who's kind of allocating capital to what things. And, you can kind of see what a lot of family offices or institutions are doing, how they're measuring it. So the GIN is a wonderful organization, everybody.
Bo, I want to challenge it. Sorry for a second.
Sure.
So who defines that an investment is considered an impact investment? Because this is a crazy number. And, if it's I'm investing in biotech. Is biotech as a whole considered impact? Is sustainable energy as a whole considered impact? Like, what goes under sustainable energy? Like, if I'm a battery manufacturer, that the Tesla battery manufacturer that stores energy from, is that impact investing in the batteries? Like, who defines this?
So it's a good question. Jin works with a lot of the different industry leaders, okay, kind of the thought leaders in this space. And, they've come up with their estimate. And I think it comes down to, there's different types of impact, everybody. There's some impact investing that they're really, they're doing amazing things, and they're measuring their results, and they're making an impact, on 50 things or 100 things. And then you could look at something on the other end of the spectrum where, hey, you're making, let's pick something. You're making pencils, right? You're making pencils. Is that an impact? So I think, to go back to my comment is, how do I say this? I think try not to judge it's important to other people, right? But it's kind of where you want to plug in and what impact is important to you. So, I think that,
I wonder if there's an index for that. Like, if there's like an investment, I don't know, asset class or category that enough people have considered it an impact, and then therefore it's an impact, and then there's a threshold. I don't know. It'd be interesting to look into that. Sorry, putting you on the spot here. But I know you didn't define it, but I'm just like, it's interesting because like $1.16 trillion of impact. Like, yeah, real estate property is an impact investment because people need to sleep somewhere, right? But I understand. All right. Anyway, it's food for thought.
Yep. Good questions. Good questions. So here's kind of some market stats on the demand, everybody. So 84% of investors are interested in impact investing. 98% of current impact investors maintain or increase their amount invested in the year. Nearly half, about 45% of high net worth investors are investing in impact investing. Yet less than a third, about 32% of investors, said their advisors had mentioned impact investing to them at some point. But the problem, right, is delivering impact investing to clients requires, subject matter expert, knowing what information to share and how to approach conversations. It can be operationally burdensome, absolutely. And there's a lot to unpack here, everybody. But Jin, impact assets, there's a lot of conferences out there. Obviously, Google's at your fingertips. But I guess my push to the audience here listening into the world is, if you haven't done any impact investing, is to learn more about it. That would be my push. And maybe one day, make an impact investment that is germane to you and your family, or the institution that you're a part of, and you think will move the needle. A lot of this, I think, is needle moving investments, right? Things that move the needle. And remember, information without execution is just entertainment. Okay. So information without execution is just entertainment. So hopefully, the call to action that I'm humbly requesting is that people learn more. And then hopefully one day, again, you make an investment that's germane to you. Okay. So I'm going to go back to this a second. So I'm going to give an example because we were talking about this before the call. So one easy kind of layup thing to do, there's a group called Kiva. So if you're in front of your computer, kiva.org, and they make microloans all over the world and even in the US. So in about 45 seconds, I could make a Kiva loan for like $10, like right now on my computer. So the cool thing about a Kiva loan is you make a loan to someone that needs a loan, and it could be they need $1,000 loan for something, or they need a $5,000 loan for something. We have to remember, everybody, that there's hundreds of millions of people out there that don't want to hand out in life. They want to hand up. And the cool thing about making a microloan, and again, I have no affiliation with Kiva, they're nonprofit, they're super cool. But the cool thing about making a loan to Kiva is you make a loan and then you get the money back. Boom. And then you make another loan and you help somebody else. You get the money back again, boom. And then you just keep recycling it, you know. So it's a wonderful organization. So how do you remember information without execution is just entertainment? So how do we do that at my house? I'll give you an example. So my wife and I, we have 2 kids, you know, we every Sunday, one Sunday a month, we open up the computer. We've got a bunch of loans, you know, that have been repaid back. And as a family, we sit together and we decide where to redeploy it. Okay. And now what's kind of happening is our boys like it so much. Mom and dad, or me and my wife and I can sit back. We could have a cup of coffee or a glass of wine on the couch, and our boys make it.
That's
and they make
amazing.
Loans.
That's amazing.
It's really cool.
So they're managing basically like a micro lending portfolio.
Yeah.
And it's just like around the world?
Yep. Around the world and the US as well. Kiva, super cool. Check it out, everybody. But you know, there's a lot of firms out there.
Check it out with your own DD before you do it, right? But yeah.
Absolutely. Yep.
Yeah.
Check it out. Absolutely. Please do your own DD. There's a lot of cool organizations out there doing cool things.
Yeah.
Okay. All right. So we're going to double click everybody on attainable housing. Okay. Because it's an area that we're involved with, that we're passionate about, and it's a huge crisis, you know, frankly, all over the world. We're going to kind of stay focused on the United States of America. Hopefully one day we can go, we and many others can go worldwide and really solve this thing. All right. So let's double click on this. So, you know, there's a lot on this slide, but, you know, we're just going to unpack it really quickly. So Pew Research Center survey found that 49% of Americans say that the availability of affordable housing in their local community is a major problem. This is a 10% increase from 2018. Okay. So, you know, they basically just asked, you know, the percent here on the left side here of this slide, percentage of respondents by demographic or location who believe the availability of affordable housing is a major problem. So men thought 44%, women thought 52%, lower income thought 57%, middle income 47%, and upper income 42%. Everybody, these are pretty big numbers, just to translate here. I mean, this is everyone I talk to, like if you're in a mountain town or you're at a resort area, a resort town, I mean, most pieces, you know, California, New York are the easy ones to pick on, but this housing crisis is real. And then further in the middle of the slide, they kind of break it down by kind of geographic region, the Northeast, Midwest, South, and West. And there's a big problem. Okay.
Sorry, again, I have these hard questions. So first, what's considered affordable? Like that's such a subjective term, right? And obviously, if you want to live in New York City, you're going to complain there's no affordable housing, right? If you want to live in Miami or in LA or in San Francisco, you're going to complain there's no affordable housing. But if you want to live in, I'm going off a limb here, probably wrong, but like Louisville, Kentucky, I don't know, is there a big issue for affordable housing out there? I have no clue. But I'm just like, these aren't like, you know, prime real estate locations. And so I really like, I mean, first of all, it's interesting sort of to define that. And obviously it's subjective. I don't know if there's a good answer. And second, and before you dive in, I am interested sort of because we did talk about impact as a strategy, and that it is subjective as well. Why did you or why did DLP, why did you guys decide to focus on affordable housing as the industry, or the sub-industry to focus on?
Perfect. Can I answer those in reverse order?
Sure.
Okay. So our why is our founder, Don Wenner, who's the CEO, who's 39 years old. He was born and raised in Bethlehem, Pennsylvania. And I'm sure if there's an Eagles fan in the audience, they're like cheering for this. So he was born, again, in Bethlehem, Pennsylvania. His parents were about 16 years old. And there's no other way to say it. They were struggling to make ends meet, because when you're 16 years old, as we all know, kids are expensive. and they're trying to finish high school and have a kid and have a job. So they moved, I think this is right. I think they moved 35 times, could be 37, but just to say 35 times by the time Don was 17 years old. Okay. And when you move that much, it's really, for many kids in America, your psychological safety and your cognitive development can be impaired. I think Don went to, 7 or 8 or something like that, third grades. The average person, when they stay in a rental community, they stay on average between 10 and 15 months. And think about it. So new teacher, right? New friend group, means kids, nice kids. And it's really disruptive for a kid to move like that. And Don went through, and his family went through a lot of trials and tribulations. And I think at one point they lived in a cabin in the woods with like no electricity. They didn't have a wealthy uncle or anything like that. So why DLP is focused on housing is because Don doesn't want any other kid in America to go through what he went through and to move all the time. We want stability in the household. Okay, that's like the bedrock for success. And what's staggering is one of the statistics is when they build a new prison, one of the key factors they look for is the third grade reading scores of that area. Oh, the third grade reading scores are low. Oh, we better build a bigger prison. So really, from our perspective, one of the key things that we can do to help make an impact and help the United States of America is to keep people in a stable home so they can stay for a long time. We want people staying in our units for, 6, 8, 10, 12 years. And, we're not going to, jack the rent up on them, right? We want to keep it attainable, affordable. Okay. So that's our why. That's why we're not making bubble guns or airplanes. It's because what happened to Don as a kid. So thank you for asking that.
Well, bubble gum isn't good for the environment, right? So it doesn't matter, right?
Pardon?
Bubble gum isn't really good for the environment. So I
Yeah.
guess it's not impact.
Yeah. Unless it's Hubba Bubba, then it's exception. Okay. So your second question was also a very good one was, hey, how does the industry define, affordable or attainable? And there's a lot to unpack here, but I just want to make one quick distinction. So there is housing where the government is paying the rent. Okay. Section 8. Okay. And that is a demographic. That's an asset class. And that's very much needed. Okay. We are not in that. We're in NAHA. So NAHA is naturally occurring attainable housing, NAAH. Okay.
Explain.
So how we define it and how the industry defines it is the rent to income. If your rents are 30% or less of the average median income, then it's attainable, or then it's workforce. Okay. So let's put some numbers around it because it's kind of fun. If the average income in the area is 100 grand, you're not going to spend more than 30 grand or less on rent. And that is by an accepted definition, attainable. Okay. For the first time in America, the majority of Americans are actually spending more than 30% of their income on rent, which is a big problem. A lot of Americans spend half their income, and some spend 70 or 80% of their income on rent. And that's just, you have very little room for something, you're one car accident away, right? One health incident away from being in real trouble. So by keeping, the rents below 30% is really, really helpful, and it's really hard to do. So that's kind of how we define that.
That's really important. I guess so. And as opposed to other subjective aspects, this is very objective, right? So it's like you look at the metrics, and based on those, it's definable. And so I love that. All right, cool. Thanks for clarifying it.
Yeah. By the way, you and I you asked such great questions, right? I mean, and we should go on the road with this. We should go on the road. Yeah.
Let's do
Call
it.
Jay Leno. No. Okay. So housing stock, the key to this slide is that the housing stock is not keeping pace with the population growth. Okay. And you can kind of see that by the lines here on the left. So the gap, frankly, continues to widen. And it's a real problem. So, this is just another example So let's look at this. Let's unpack this. So the average 30-year fixed mortgage rate as of October, okay, I mean, it's a slightly dated, is about 8%. Okay, so it's 52 more expensive to buy than it is to rent. Okay, and then, you know, I'm at the bottom left here, this 2,866 number. So the typical monthly mortgage payment is 2,866. So 38% of median income for a typical mortgage. I mean, that's just, there's a big problem here, everybody. And, you know, it's funny, I read this article, maybe it was a year or 2 years ago, where, and I don't remember where I read the article. Was it the New York Times? Was it the Washington Post? It doesn't really matter. What matters is this reporter tried to blame, his whole thing was, hey, I want to put, you know, he never once offered a solution, but he wanted to kind of point blame at why we have a housing crisis. So first he blamed the real estate developers. Well, it's all their fault. And then he blamed all the trades men and women, you know, the plumbers, electricians, and the roofers. They all charge too much. Well, and then he blamed the commodity producers, right? Timber and, you know, copper and steel. You know, it's their problem. It's their fault. And it was but I read the article. I was like, this guy missed it. He missed the problem. He really missed the core of the issue. And the core issue is the in-place zoning laws, okay, for most, not all, but for most municipalities and cities and towns across America, it's so restrictive to add more supply. And it's really hard. It's really hard to bring supply to the market that's attainable for the local workforce, because the in-place zoning, and that's really where we need to crack this egg open. And there needs to be a lot of reform in that area. Okay.
So someone in
Sure.
GoBundance, in the group we're part of, a few months ago shared this graphic showing rent versus buying in 2020 in the US. You remember that? You know that the one I'm talking about, and then rent versus buy across the US in 2023. I'm going to put it here in the chat
Sure.
to everyone here. And this basically, and when it was circulating in the chat we're part of, was like, you know, people were saying, yeah, it's rent has gotten really cheap, and so that's why it's changed. But then when you think about it, the reason it's so much more cheaper to rent isn't because rent is cheaper, it's because buying is just so much more expensive because of mortgage rates, right? And so it's really important to emphasize that point, right? Because of these rates, people can no longer afford to buy, and so more people are going to rent, which in return will probably increase, you know, rental prices as well. So it's really interesting dynamic, an important dynamic to take a look into, and also understand at some point, you know, interest rates will cool down a little, but they're not going to go back to where they were, you know, a few years ago, to zero. So yeah, that's really
good point.
Important metrics.
Good point. So yeah, everyone, you know, definitely click on that link in there, and you know, assuming that you're interested and learn more about it. We talked about the material costs, you know, just earlier, right? So the price of wood's gone up about 16%, steel 22%, concrete and masonry 15%, you know, electrical conduit 12%, insulation 11%. I mean, it's tough. It is tough, everybody. It's a tough market for sure. So this is the last slide here. So a lot of people, after hearing this, and I always love, by the way, if you ever talk to anyone and they just kind of, hey, here's a big problem, and then they kind of walk away, like, no, like, it's okay to say what a problem is, but what are some solutions, right? Like, I need some takeaways here. So, you know, definitely challenge people if they don't come with some solutions. So here are some solutions, everybody, that you can do yourself. You can invest in new supply. You can invest in older assets. So you can do development or value add. You can do it yourself. You can invest in home ownership, take advantage of some tax reform. You can lobby federal, state, and local governments to change their zoning laws. You can spread the word. You can pray. Maybe do a rain dance. Should we add that too? Should we do some kind of a rain housing dance? But big picture is, I do know people that have bought, you know, a home in their neighborhood, and, you know, they don't make any money on it. They just cover their mortgage, but they rent it out to a family that, you know, that needs it. And that's, hey, you're being part of the solution right there. So there's a lot of cool things that people can do. So that's it, everybody. We have this QR code, which takes you somewhere. But again, I'm just so honored and I'm so honored and grateful to be part of this. And if there's any questions, we'll take them.
So before, can you go back a few slides
Sure.
to the one of the number slides? Not this one, the one before this. This one, no, one below. So what we're seeing here basically, because I didn't really get a chance to digest this, right? Basically, it's total households formed is the orange one, and then families formed. So there's pretty much correlation between that. And then what's the total housing stock? So how does that make, households formed? So all right, I get what you're saying. All right, so what's the difference between households formed and families formed? Sorry, isn't that the same? Hard question, I guess.
Yeah, I like it.
Anyway, let's just say it's the same thing. So what we're saying basically is that there are more people being born and families created than houses being built.
That's
right?
correct. And I think how they make this delineation is you can have a large family in one house, right? But at some point, some of those kids get old enough where they need to go get their own house, and that's another household formed. Okay.
Okay. And so the housing stock, because this would mean that there are no empty houses in the U.S., no empty apartments in the U.S., no empty condos in the U.S. Right? Because I've seen this. This is obviously a statistic that's being thrown around everywhere in the real estate industry, especially in real estate, conferences and stuff like that, which are biased towards real estate, obviously. But again, essentially, what it means is that people don't have a place to live if there aren't enough houses. But people are living places, right? Like, and there are empty houses as well.
Yeah. So I think there's some froth, okay, in the market. Okay. There's always some froth. And that froth means there's just some type of transition. Maybe somebody owns 2 homes, right? Maybe somebody owns 5 homes. People are always moving, right? I mean, look at the migration, the primary and secondary migration. So the primary migration into the U.S. is kind of California, New York, kind of the coastal. And then there's the secondary migrations where they go to other places, and that's primarily like people go to Idaho, Colorado, Utah, Texas, the Southeast. So there's always some froth, where it's transitory. People are moving. So there is some open homes. But there's a lot of people that are, multiple families living in one house. I mean, there's just a lot of that happening, and there is a shortage for sure. But to your point, like if you could probably go easily find a vacant home somewhere, but we just don't know the individual story with that vacant home, right?
And
is somebody moving or whatnot? Yeah, go ahead.
And so essentially, if we're talking about impact investing specifically in the affordable home housing crisis context, do you guys predominantly build like new builds in those areas where you can achieve 30% of the average income? Because if you buy and renovate, usually that will be, that requires more meat on the bone, I'd assume, the value add, but then you have to have rental prices above the market or at market.
Yeah. So DLP, we finance the development of thriving communities, okay, at a very high level. So DLP, we are owner operators, and we develop new product and we buy existing product. We also provide debt and equity to other real estate operators that have the same mission we do, is to buy existing or build attainable housing. Okay. Now let's unpack the two, because it's another good question on your part. So when you buy existing, this is generally speaking, when you buy existing, it generally, you can generally buy it cheaper. Okay. Like, so when we're looking for that average medium income, that average area, if you can buy an existing there, you know, again, we're really good buyers. And if you're a good basis buyer, everyone, just to be clear, when you're a really good basis buyer, what that means is you can buy something and the very next day you can sell it for a profit. The very next day. That generally means you're a good basis buyer. So when you buy right, you can generally keep those rents attainable. Okay. You don't need to, you know, in that local market. But where we struggle is when we build, because building is more expensive than buying existing, is, remember, we're in NAHA, right? Naturally occurring attainable housing. So we have to go to areas where the average income in that area can support a little bit higher rent because we're building brand new. Okay. So that's a good question.
So
It's
the
a
new
really good
builds, so the
question.
new builds are by definition in the higher income areas, and
But still 30%, everybody, just to be clear, they're in the higher income areas, but they're still 30% or less of that area income. So yeah, go ahead.
right. Just because like as an LP, I've always invested, you know, in you know the value add type deals, which by definition are value add, and they, you know, they you know, they hold in the whole definition of that deal. They buy it, they renovate it, they increase prices, and then they sell it, right? So I'm assuming the vast majority of those multifamily value add type deals it'll be very difficult for them to be considered impact investing, right? Or am I wrong?
Yeah, and there is some stat, and I don't, you know, this is like directionally correct. Most syndicated value add apartment deals are kind of trying to buy a class B and take it to an A, right? So they'll put $50,000 per door, but in order to get a return on that investment, they really have to, you know, increase the rents. And that somebody said that was like, gosh, what was it? 60 or 70% of the syndicated deals out there are just, they're not attainable housing, right? Or not affordable, however you want to, whatever vernacular you want to use. So you're right. Most of them, most ones that you've probably seen in the because the majority of the ones in the marketplace are that. So we're in the minority. And so are many other people that are, I think, doing cool things. You know, we're trying to keep it, you know, in that C or B rent range, if you will, right? If we're going to buy existing, and you can still build brand new, everyone, just to be clear, we are right now, we're building about 10,000 units in one of our development funds. And all these will be very attainable for the local markets for sure. So you can do it, to be clear.
And profitable.
And profitable.
And if we're already out, I mean, I'm going to give this question into, so I saw there's a question here about IRAs and 401k. So I'm just assuming like, yes, you can invest in these things also through your IRA and 401ks, just like almost every fund, which is important. It's an important way to generate more wealth, obviously. Any other questions that we have out here? Because I hogged a lot of the time here. Danielle? You're on mute.
There was, no, I saw that. There was another question about how does DLP mitigate the risk now with markets being so volatile and potential recession?
Okay. So I heard the first part. Can you say the last sentence again?
Sure. Sorry. Let me read it out again. The markets have been volatile with potential recession. How does DLP mitigate this risk?
Sure. So there's a lot of ways that our investment team mitigates risk. So I can't, you know, I'm going to give you the high level because we could probably spend, you know, hours and hours on that phone call, or sorry, on a phone call with that question. But let's just start at the macro and then drill down a little bit, and then I'll hit the pause button. So the big picture is, you know, if you're going to, I think if you're going to buy a public stock or make any kind of investment, is who's the underlying customer? You know, what's the supply and demand? Okay. And, you know, there's a supply and demand gap right now with attainable housing. And there's a chorus of research out there that kind of says there's a range between 5 and 8 million. There's a shortage of 5 to 8 million attainable housing units in America. Okay. And I can tell you from the DLP side, like that's a really good spot to be in when there's that big of a gap, because the moment we deliver these products to market, boom, they just rent like hotcakes because there's a shortage. So that's a big tailwind to have at your back. Okay. And then there's some other things that are very important. Again, so remember, DLP, we do this ourselves, but we also provide financing to other real estate operators that have the same mission we do. So we kind of focus on three things. When you're underwriting a deal, I think you should pay attention to these because it helps mitigate risk. Number one is, the background of the sponsor. What's their track record? How many deals have they done? Have they been a good, what's their credit score? Like you got to do the whole background check. Number two, what market are they in? The market can really save a lot of bad deals because if there's so many people moving there, or there's just such a bad supply and demand gap. So to recap, number one is the sponsor. Number two is the market. And then number three is the deal itself. All the details that encompass that deal. What's your basis? Is it a value add or construction? Is it, what's your basis? What are the rents around the area? How much new supply is coming online? What's your cost per square foot? What kind of rents do you think you can get? So there's kind of those details as well. So hopefully that answers your question, at least at a high level, and happy to dig deeper later if you want to.
Thank you. We have another one about opportunity zone. So I'm not sure, does DLP does any opportunity zone investing or funds?
So it's a good question. Opportunity zones, don't let the tax tail wag the investment dog. Okay. So there are a lot of good opportunity zone deals out there for sure. There's probably a lot of bad ones too. We do not have any opportunity zone opportunities at the moment, but that could change. And this made national news. So DLP, along with one of our partners, we own about 20 city blocks in downtown Jacksonville, Florida. About 20 city blocks. And it is estimated that it will be one of the, if not the largest revitalization of an urban core in human history. And it's pretty exciting. And that is in, to my knowledge, again, I'm not a total expert on that specific deal, but to my knowledge, that is in an opportunity zone. So there could be something down the road that is unfurled on that topic. But at the moment, we don't have an opportunity zone opportunity. But again, my opinion, they're definitely worth looking into for sure.
Yeah, there's actually a lot of good opportunities in Jacksonville. I think they're also doing something with the marinas there, and so definitely something to look into. We have another one. What percentage of your hold on, how much wealth do you think someone should have to consider impact investing versus profit only investing? What part of your portfolio should consist of impact?
Whoever asked that one, that's a good question.
I think, yeah.
So, like all good questions, I guess it depends. So some people, I know some people, they have 100% of their portfolio in impact. I mean, they're just all in. I know other people that don't have really any. Again, we're here to enjoy your journey and not judge it. And then there's people in between. But I think the reason, maybe the impetus behind the question is like, where's a good place to start? So, I read the other day, I guess you could, the safest answer is start wherever you want. But a rule of thumb is you could always start with, 2 to 5% of your portfolio. 2 to 5% is a good rule of thumb in impact. Obviously, spread it out and diversify it and do your research. But, you can, 2 to 5% is a rule of thumb that I heard the other day. I also heard that 1% of your wealth should be in Bitcoin. And if it's 1%, so if it goes to zero, who cares? And if it goes through the moon, hey, that's good stuff. So, but I think it makes sense. I think it's safe to say if you start small, right, crawl before you walk, kind of thing.
So I have an interesting anecdote on that. So when we, after we sold the last startup, we went to sort of, sit with a bunch of different investors and just like ideate and brainstorm. And one of the investors we sat down with, me and my co-founder Tomer, said, yeah, we want to do something like impactful. We want to do like a business that really does good on the world. And he's like, do a business that makes you a ton of money. And then when you make a ton of money, then do good with the world with that money. That was like, and it's still like, that was like years ago. And that's like still in our head. So I think, yeah, there's such a big spectrum of it. On the flip side, if you never make a ton of money, then you're never going to do any impact. That's also stupid. So I guess that it depends, as you mentioned, on strategy and where you're at. Yeah, I think that was a good answer though.
Thanks.
I'm gonna embarrass you a little bit, Litan, and say that very starting the early days of Vyzer, we always had something that was always important for us to also do something that will do good, whether it's for veterans or whether it's helping people. I think it's always important to have a part of, whether it's in your portfolio or in your personal life, where you're just trying to help and do good. And if you can make a profit, then it's always better.
100%. Now, I'm not saying that's what we did. I'm just saying that's what he advised us. He advised us to do. We're definitely doing good in the world.
Yeah.
All right.
I have
Anything else?
one last question, Bo. Just do you find that people that are more into impact investing, do they want to be more involved in the decision-making process? Do you find that they're more involved in the day-to-day process, or is it just, in the end of the day, they're just writing the check and expecting to see the returns?
What I generally see is people, when they have both, okay, a lot of people have both, right? Impact and kind of just call it non-impact. And what I generally see is people have more passion and more energy about their impact investments. And that's what they're talking about, around the barbecue or, in the grocery store, wherever you run into these folks, they just have more passion and energy because that's what they're talking about more often. So that's generalization. And I think that's true. And then the other thing that they're usually tracking I notice people, they track the impact pretty hard, right? They want to know, hey, how many jobs are we creating, or how many things are we doing that are helping the world? Like, they really like that. They have a tracker sheet. And then they're sharing that tracker sheet usually with their family at their monthly family meeting or quarterly family meeting with their kids. So, you can kind of start to include it's easier to include your kids and stuff like this, as opposed to just say, hey, we own Ford stock. Like your kid may look at you like, okay, right? But when you start to drill down an impact, it generally speaking is more interesting. Of course, there's always exceptions. But I have noticed that another thing that I noticed is that some of the demographic of like the really passionate impact investors do take a board position. So they become a hyperactive board member, or they volunteer to be part of some committee or something, or they'll host a local dinner in their neighborhood or in their town, to share with other people about what they're up to. So that's kind of how I would answer that question.
We should add that to Vyzer, Litan, letting people track the impact of their investment, not just
100%. That's like, yeah, it's a great metric to add per investment. All right, we're at time here.
Thank you,
Bo,
Bo.
I want to really thank you. This has been really interesting, enlightening for me, and always fun chatting with you and sort of the way you look at the world. So I appreciate that. I appreciate you for being here, and thank you everyone for joining us. Is there anything you want to add before we wrap it up?
Just thank you. Thank you to your community. Thank you both for hosting me. And again, I love what you're doing, and I love what you're helping your clients solve. It's desperately needed in the marketplace. So I'm a big fan of yours. Keep doing what you're doing, and keep making the world better. Okay.
All right, buddy. We'll stay in touch. Thank you so much. Bye, everyone.